You might not realize this, but there's a secret loan approval formula that banks and lenders use to decide if you'll get approved. And it's not all about your credit score. Stick with me, because by the end of this video, you'll have the exact strategies to maximize your chances of approval. And I'll even share something most people overlook that could make all the difference. First, let's break the biggest myth about loan approval. It's not just about your credit score. Now, don't get me wrong, your score matters, but it's far from the whole story. The lenders are looking at a combination of factors that go far beyond your credit. The secret to cracking the loan approval code is understanding how these factors come together and what you can do to improve them. For example, did you know that your debt-to-income ratio can actually be a bigger factor than your credit score? This simple number compares how much debt you have to your income. Lenders use it to see if you're taking on more debt than you can handle. A low debt-to-income ratio means you're managing your finances well, and that's an attractive quality for lenders. So if you're carrying a lot of debt right now, paying down high-interest loans and credit cards could be your ticket to improving your loan approval odds. Now here's something that most people miss. Lenders want to see your stability. They look at how long you've been at your job, how long you've lived in your current home, and if you've been financially stable for a while. If you've been jumping around, it can signal uncertainty. But if you have a solid, long-term track record, lenders see you as a safe bet. This is where many people fall short. I know from personal experience working with countless clients that the stability factor is often ignored until it's too late. So, if you're moving around a lot or switching jobs, try to stay put for a bit before applying for a loan. Even a few months can make a difference. But here's something that most loan applicants overlook. Your assets play a significant role too. It's not just about how much money you owe, it's about what you own. Lenders want to see that you have something of value to back up your loan. The more assets you have, whether it's a home, retirement savings, or investments, the better your chances. Why? Because lenders feel more secure lending money to someone who has something tangible to fall back on. So, before applying for a loan, consider building up your savings or investing in assets that can work as collateral. And here's a little-known trick. If you're trying to secure a larger loan or a business loan, consider having a cosigner. A cosigner can dramatically improve your chances of approval because they're essentially guaranteeing the loan. However, this comes with a major caveat. You need to be sure the cosigner has solid credit and financial stability. Otherwise, it can work against you. Now, I've got something important that I want to share with you, something that could make or break your loan approval. Many people don't realize it, but lenders actually look at your credit utilization ratio. It's not just your credit score. It's how much of your available credit you're actually using. The less you're using, the better it looks. So if you're maxing out your cards, or even using more than 30% of your available credit, your chances of approval drop. Pay down those balances before applying. Finally, one thing you'll want to remember is that lenders aren't just looking for numbers. They're looking at patterns. If you have a history of making consistent, on-time payments, your credibility goes up. If you've been late on payments, even once, that could hurt your chances of approval. But here's the good news. You can fix this. If you know your credit history isn't perfect, you can make it up by making timely payments for a few months before applying for a loan. Even a few months of consistent payments can shift the lender's perspective. So, to recap, focus on your debt-to-income ratio, build financial stability, increase your assets, consider a cosigner, and always monitor your credit utilization. But, most importantly, remember that loan approval isn't just about meeting the requirements. It's about showing the lender that you're a reliable, stable, and trustworthy borrower. If you found this information helpful, consider subscribing to the channel. If you want more tips like this that break down complex topics into easy-to-understand strategies, make sure to hit that notification bell too. You don't want to miss what's coming next.